Hey, this is Ken from JasonInvesting.com. Welcome to our episode 2. Joining us is Jason, our CFA, who is today going to teach us how to trade options. If you're interested in this subject or just starting out, be sure to watch this and follow us. This episode is sponsored by Jason Investing newsletter. You can sign up on JasonInvesting.com. In this newsletter, we will show you how Jason actually invests in the S&P, leveraging dollar cost average and option to maximize returns and minimize risk. Okay, let's get into the episode right away. I'm super excited. Hey, Jason, how are you doing today?
Hey, Ken. I'm doing good. How about you?
I'm doing really good as well. I mean, we
I know
are.
you're feeling really excited, so
Yes.
I'm feeling excited too.
Yeah, and Andre, how are you doing?
Yeah, I'm good. I'm good for weekends. Really good.
Cool. I'm so excited. Let me just get right into it and fire some questions to Jason. So I've been reading your newsletter, right? I mean, I wanted to. There's some things that I don't really understand in there, and I wanted to get some clarification. Right? So in your first newsletter, the issue 1, I know that you purchased the SPY, right? And then you also make some options trading, right? So this happened on, I think, February 27th, if I remember it correctly, right? So you bought some SPY and it's total around like $45,000, right? And then you also make it 4 trades for option trading, right? And then I think there are a mix of call options or maybe some put options. I just wanted to know, right? I mean, how, like, what are these options doing, right? Like, why do I even need to buy these options, and why am I buying so many options?
Yeah, okay, that's a very, very good question. So basically, the fundamental portfolio strategy that we employ is just a normal dollar cost averaging. So basically, you just buy SPY shares, right? So we started off with 50K on the 27th of February. So we bought around, if you look at the trade statement right now on the screen, right? The SPY shares, we bought 90 of them at a transacted price of about 507-ish, right? That comes up to about 45.6K USD. So we had about like another $5,000 left. And I then employed that into the options as part of the overall strategy. Okay, so the underlying, the main is the just normal dollar cost averaging. So we just make the assumption that we start off with 50,000. This is just a arbitrary number. Like it could be any number. For example, with any number that you start off with, and then every month we just assume that the investor would put in deposit another 2,000 USD, and then would just buy however much shares that you can get with 2,000 USD. And the options, so the options trades are more for leverage purposes. So we want to enhance the return by dabbling into risky trades. Because these options are all hedged in the sense that they are not naked options. So all maximum losses we will know upfront, and the losses will be capped. So to me, I see it as a kind of like a lottery, in the sense that if the trade do make money, we will make a lot of money, right? Compared to the price that we pay for the options. And if we lose, we only lose the price, the premium that we, the maximum loss. So you can see as the maximum loss is the lottery ticket, which is small compared to the potential winnings. But of course, there's no such thing as such a good thing that you put a little bit of money, you can make a lot of money, right? So basically, the chances of you making a lot of money is not very high. Just like a lottery, the chances of you winning a lottery is not very high. But in our case, the odds are a lot higher to make a decent return. And also based on the strike price that you choose, you can increase the chance. But basically, we are doing a directional trade in the sense that we, in this case, the initial trades that we make, we are betting that the market would continue to go up. Yeah, so basically, that's why we incorporate options. Do you want to let me maybe I pause and you have any more questions first?
Andre has
Yeah.
a question.
Oh, yeah. Just now when you mentioned about lottery kind of method for not method mindset for options, what are the ways you would think about to kind of minimize this kind of risk or kind of increase the chances?
Okay, so the way we increase the chances is by increasing the price of the lottery ticket. So the cheaper the lottery ticket is, the less chances of you winning the lottery, right? So as you put in more, you risk more money upfront, the chances of you making more money, making money increases. And okay, so the way, and also because of the way we choose a strike price, right? Later we were going to, hopefully, if we have time, we're going to what we call in the money, and the money, out of the money call options or put options. Those the moneyness of the option would determine the price that you would pay for the spreads or the option trades. So so basically, the rule of thumb you think about it is, the more money I put in, the higher is the chance. But you also increase your maximum loss. So it's like a balance. You want to strike a balance. And choosing the moneyness, whether it's in the money and the money out of the money, which we'll cover later, would depend on the strike price that we choose. And the strike price that JasonInvesting choose is based on the statistical model that I do, that is based on the volatility of the underlying, which is the SPY shares. So we can project out the volatility, and I kind of like determine, what is a likely price that the underlying would probably fall within a certain range. Now I will choose the strike price accordingly. Anyway, all this detail we will go into detail later.
Okay, cool.
Yeah.
Just to be clear, right? So if all these options do not work out, right, what is my actual maximum loss in terms of dollar value?
Okay. I believe we. Let me see. I think it's in this issue too. We actually cover the cost spread. Let me just see whether we have it here. Oh, I think it's issue 3. So all these newsletter, you can actually subscribe, and you're able to access them for free. Okay, so sorry, can you repeat the question again? What's the maximum
question,
loss, right?
Yeah, maximum loss for all the options.
Okay.
Right?
So for example, if you look at this option trade that we employed, that we did on 27th of February, it consists of various spreads. So we have a plain vanilla call spread, and also some diagonal spread. But now we will just talk about the simple version, which is the call spread. So if you look at the payoff of a call spread, right? So this is the payoff of call spread. Your maximum loss will be minus 10. Okay, this is just this one is more one that this one is a more accurate version. Okay, but anyway, we go to a simplified version. So this version that you see here is based on the trade that we did on the 27th of February. But this one is slightly more complicated. As you see, all this number here is not so round up number, right? So I just made a simplified version first, which is just a round figure. So this is just a hypothetical example. It's not the actual one that we did. If you look at this call spread, basically it's saying that your maximum loss will be minus $10. But of course,
Okay.
if you multiply by 100, it'll be $1,000. So your maximum loss will be minus 1,000. The reason why we multiply by 100 is because every SPY option contract is made up of 100 shares. So it represents 100 shares. So you need to multiply by 100. And then our maximum gain would be, I think in this case, is 25. So 25 multiplied by 100 to like 2,500. So you're like risking minus like $1,000 for a potential gain of $2,500.
Okay. So in this case, we traded 4 different options. Does that mean my maximum loss would be around like $4,000, right? In this example, whereas the premium is like 10 cents, right? If I lost, is that how I $10? Sorry, $10, not 10 cents.
Yeah, okay, for the simplified version, it's $10.
Yeah.
If you look at the actual trade that we made, which is down here. So this is I even have had this in the newsletter. We did the computation, right? In this case, it will be minus 11.18. That will be one contract. So basically, it's one long 505. So okay, if you look at this, okay. Now, how about this? We go through this trade first. Okay, so you see there are some. Okay, so this is IBKR interactive broker trade statement. So you can run. So I highly suggest for subscribers to just open an IBKR account, because in that case we can give you instruction and tips on how to actually use it and run reports. So this is just a trade statement that is generated for the 27th of February. As I said earlier, 90 shares, transacted price is 506. That comes up to about 45.6K USD, right? So, and then we short 1 March call option, 525 call option. And then we long 505 April call option, followed by we short 540 and 560 for April and May. So the way to read this is, so this is the name of the option contract. So it consists of the expiration date. So basically this means 15th of March 2024. So this is the expiration date. Remember that we are talking about 27th February, right? So this one is in February, but the expiration is in March. And the strike price is 525, and this is a call option. And -1 just means that we are short. Because each call option is 45, each contract is 45, 0.45. Because remember, you need to multiply by 100. So we get a premium of $45. So this is, rather than paying 45, we get a premium. We get cash, $45 cash upfront. Okay, so this is a 45.
I don't just want to go back to this about the quantity part a bit, right? It says -1, right? Can you clarify that? I don't really quite get that.
Okay, so similar to a stock, you can long and short a stock, right? If you're long, it means you buy the shares. If you short, means you sell it.
Yeah.
So for option contract, you can long and you can short an option contract. So you long means you buy the call. You short means you sell the call.
Mm-hmm.
So in this case, negative means just short. So for example, if this is +1 instead of -1, right? That means I will have to pay $45. But in this case, so for example, there's a counterparty. Every long has a short counterparty. Every short has a long counterparty. So I'm the short counterparty. My counterparty that I face will be the long counterparty. So that person will have to pay me $45. Yeah, because I'm short, right? He's long. So if I'm long, I'll pay the other person $45.
Okay. Does short mean I am selling a call option here, or
yeah,
what does it
call option.
Okay. So basically, on February 27th, not only did we buy the shares at 506, right? We bought $45,000 worth of shares, and then at the same time, we actually were selling a call option, right?
Correct.
That's what we're doing. So that's why immediately we get $45 back, right?
Yeah, but then if you see, in actual fact, we only got $44.20.
Yes.
So yeah, that's because of the 80 cents commission here.
Okay,
right?
that
Just in case
makes
you're
sense.
curious.
Okay,
Yeah.
that makes sense. Okay, what's the catch here, right? I mean, like I could have just every day I could be doing this, right? Like by selling this call option and I get some money back. So yeah, what's the catch?
Okay, so catch is a huge, big catch. It's a huge caveat. When you sell an option, be it a call or a put option, if you just sell the option, right, it's considered a naked option.
Okay.
And a naked option has unlimited risk. So basically, your maximum gain will be only $45,
Okay.
but your losses is unlimited.
Okay, my
So that is
losses.
actually
Okay.
yeah, it's unlimited. So basically, okay, we start with the basics. So basically, 525 call just means that if on the day of expiration, right, on the 27th, on the 15th of March, if the underlying SPY shares is below 525,
Okay.
right now it's 506, right? At the 27th February, it's 507. So if it reached 525, you would okay, if it's below 525, that means your option will expire worthless. So you get to keep this $45,
Okay.
right? But if it goes above 525, right?
Yeah.
Every $1 it goes above, you will lose a dollar, right? But because it's multiplied 100, you will lose $100. So the thing is because the SPY shares can theoretically go to infinity, right? There is no cap on the. Of course, the chances of that is zero, but basically, SPY shares can go up very high. So if let's say if it goes to 530, there's a difference of 5, right? So basically, that's $500. So you will lose $500, but because you gain the $45, so basically you will lose $455.
Okay.
Yeah.
Just wanted to clarify that, right? What I lost, the unlimited loss, is an opportunity cost, right? Is it because I still earn, right? Because it makes no it seems so weird. I'm spending okay, I wanted to earn $45. And then my trade-off is unlimited loss, right? That seems super weird to me. So I just wanted to clarify, is it just that big loss that I'm having for every dollar that it goes up, is it because I am forced to sell my $45,000 worth of shares I hold in SPY? Do you mean by is that the
Okay,
case?
if we're talking about just pure naked call option, right? If you just
Yeah.
short a naked call, yeah, it will be. But okay, but the thing is, we don't do that for our portfolio, and I don't suggest anyone to do a naked call. But a lot of people they do it because the chances of you think about it, 525, right?
Mm-hmm.
Divide by what is the price now? 507, right? 507. We're talking about 3.5%. 3.5 if you minus 1 is multiplied by 100, right? So basically it's 3.5, about 3.6%. So within from 27th of February to 15th of March, basically it's slightly more than half a month, right? In 2 weeks' time, you expect the market to go up 3.5%. The chances is not very high, right? So basically a lot of people say that, the chances is not that high. So I take the risk. I make $45. It's like selling insurance.
Okay.
Insurance company, they sell insurance, they get the premium, right?
Yeah.
If nothing happens to the person, the insurance company don't pay out, right? They will just keep the premium. But if something happened to that person, they'll have a huge payout. So it is similar to that.
Okay, this is such a very good trick. So what you actually did is you divided the potential price in that call option is 525 and divide by my current price is 506, right? And then you calculated, okay, it's like
that's
3%.
The underlying price, not the options price.
Yeah.
That's the underlying
okay.
price.
Underlying price. And then
Which is
I just
SPY price.
That makes sense. So basically I just think about it, okay, in this period of time, is it easy to get go up? If it's not, then I just maybe sell this call option. Okay, that's a really good trick.
Yeah. But the reason why I sell the call option, it's not because I want to get it's not because I don't want the market to go up to 525 and above. On the contrary, I actually want the market to go up above 525. Yeah, but the reason is because I am doing a spread. So I'm doing a combination of option trades. It's not just that short option. I have another long option. So basically, and then people will say, then why you do the short option and not just a pure long option? It's because the short option can reduce the premium of my long option. So the way I do it, the idea, the intuition is the short option would reduce the cost of my long option.
Okay. So basically, you short and then you have a
to reduce the price.
Okay, reduce the price. Okay, I just wanted to go back and clarify this first. In the case that we own shares of SPY and then we sell a call option, but at the time it expires, and then if the price is above 525 in this case, I still didn't really lose money. I actually earned money. I earned $45, and I also earned the gains from the 45,000 all the way from 506 to 525. Overall,
No,
I'm
you
still
don't.
positive, right? No.
Okay, you don't unless you have the underlying. So for example, if you have the SPY shares, right, underlying, and you sell a call option, then from 507 to 525, you'll make the gain, right? Because you have the underlying shares, right? Or if you have another long call, then you will write the gain. But if you're just pure short naked call, your maximum gain is only $45. You don't make anything. But if you have an underlying, like for example, like minus one means minus one contract is 100 shares, right? So if you are long 100 shares, like this one is 90 becomes 100, right? So if let's say we have this 100 shares here and this minus one, just two trade, right? So basically it will be called a covered call. It's a covered call. The reason why it's called covered is because it's like I mean, this thing sounds a bit sexual, but naked call, you're naked, right? Covered means you are covered. Your certain area is covered. So basically, if you have the underlying shares, you are covered. You're not entirely naked. So between 507 to 525, you will make the money, right?
Okay.
How much is that we're talking about? 525 minus 507, right? So that is 18 multiplied 100. So that you will make $1,800 plus the $45 you make. So you'll be 1,845, which means that if by expiration SPY closes at 525, you will make $1,845. You will not lose anything. But for everything going up above 525, you will lose $100 for every dollar increase.
Let's run through an example, right? What happens when it's 530, right? For example, 530.
Sorry, I just correct. If you are covered call, you will not lose anything above the because you are covered, right? And so any losses you make on the short, you will make from the long. So basically, it will stop at 1845. Yeah.
Okay. That makes sense. Yeah, that's what I wanted to clarify. Okay, perfect. So that makes more sense to me, right? Because there's no point to bet. Oh, I just wanted to have $45 and maximum loss. Okay, that makes sense. And then you said the other thing is you are also trying to hedge this call option in here to reduce it, right? Can you talk more about that part?
Okay, so let's just ignore this March option for now, right? We focus on this two option, the April option, because they are the same expiration date. And this and this three, you just imagine it's one. Okay, so because the way because when I did a trade, I did all of them together, right? Basically, this one long call matches one short call. One long call matches one short call. One long call matches one short call. That's why this is three, right? In actual fact, these are tied up together. So 505 versus 525 is one trade. 505, 540 is another trade. 505, 560 is another trade. So so let's just do this. So if I have a 505 call and a 540 call, right? This one and minus one is called a call spread, which is basically this one. It's a cost
And you're
spread.
selling both of them, right? This is a
No, I'm long the 505 April call and short
okay.
the 540 call. So if you think about it,
Yes.
if I were to just buy one contract, right, for 505, I will have to pay 11.18,
Yes.
right? It's a transaction price. Multiply by 100 means $1,118, correct?
Yes.
But by selling this, I can reduce by $70. So basically,
Okay.
11.18 minus 0.7. In this case, it's just a little bit of reduction,
Very
but it's
little. Yeah.
still very little, but still it's worth it because the chances of hitting 540 is extremely low, which means that this $70 probably I'll pocket it. Even if I don't pocket it, which is actually a more ideal case because it means that this long option is making money, right? But
Yeah.
then but the thing is there's no free lunch. Okay, this Andre might be very interested to know. In finance, we have this no free lunch philosophy. So basically, nothing is free, right? There's always a catch to it. Like for example, if I reduce the cost to the long option, there must be a catch, right? Right? If not, like why would people just not buy the long, just the long? You always match it with a short. The reason is because you will cap your profit. So you see, this is your maximum loss. Then you go up and you cap, right?
Mhm.
Yeah. Okay. So okay, now that okay we see so we have this long call 505, right?
Mhm.
505 long call. So 505 long call is basically this blue line, right? This blue line. This is a
Okay.
payoff diagram.
Okay.
11.18. Remember 11.18, 11.18, right?
Mhm.
So basically, your maximum loss is 11.18. If you just long the call option,
Mhm.
your potential gain can go up forever, right? It can go up. You can just think
Mhm.
about as the underlying because this stock price is a SPY share. As the underlying goes higher, you make more money, right? This
Mhm.
is the blue line. And then the short call is one. Your maximum gain is $7, right? 70 cents just now multiplied by 100 is $7. So basically, if it falls below 540, you will make the maximum gain $7, right? But if it goes up above 540, your losses is it will just keep on going. That means it will get more and more negative, right? Your losses become more and more negative. So basically, because theoretically, SPY shares can go to 500, 600, 700, 800. It can go sky to the moon, right? So if it goes to the moon, then your losses will go to the moon. But because we are doing a spread, we are adding this blue line and this orange line together, which give you this green line. That means your gain, your maximum gain is capped at 30.20. Your maximum is capped. So basically, if it goes 540 and above, you will only make a maximum 30.20. So the catch, the no free lunch in this case, is that you will cap your maximum gain. If you just long the call option, if it's like for some reason the market actually rally, wow, Fed cuts the interest rate, and all the tech companies, Nvidia, Tesla, Facebook, Google, all have super high earnings or whatever reason, the market went all the way up. Oh, then your call option, you just spend $1,118. You can make potentially 4,000, 5,000, 6,000, 7,000, right? But in this case, if it's a cost spread, your gain will be $3,200. Three
Okay.
thousand yeah, $20, yeah.
But at
So
the
you're
same time, if
risking
there's a loss, is a cap on the loss as well, right?
yeah, the loss is okay.
Yeah.
Yeah, exactly. That's a very good point. So remember, we said that the maximum loss was 11.18, but now
Yes.
your losses become reduced to $480. 4.80, right? So you can think about it. If if the market goes above 540, this is your maximum gain, right? So you are risking 480 to make 30.20, right? So 20 divided by 480. So this is like 6 times, man. You're making 6 times, like 600% on the money that you lose for a potential gain of 30-20. It's a difference of 6.3 times, which is why a lot of time option seems to be very lucrative. It's because wow, we can make such leverage. People will be like, oh my god, I want to do this, right? But then again, always you need to think about, remember this, there is no free lunch. So what is the catch here? I will open the floor to the two of you. You want to answer this question? What is the catch? Okay, so let me repeat again. You are risking 480 for this cost spread to make a maximum gain of 30-20, which is 6 times more, right? If it goes 540 and above, you make 30-20, just risking 480. But what is the catch here? Like, why wouldn't anybody just do this trade, right? Like, why do I want to buy the underlying, man? I'll just do this, man, right? We're talking about 6 times. What is the odds of SPY making 600% in a matter of how many days we're talking about? This is 27th of February. Expiration is April, right? So it's just a little bit more than 2 months, right? Maybe about 2 months because it's the middle of April, right? So what is the catch? Like, why wouldn't everybody just do this trade? And the important question is then why don't Jason Investing do just this trade? And why are we doing all this dollar cost averaging? Like why don't we just do this?
I think it is to average out the risk. That's all.
Okay, that's a good point. That's the risk. So is this trade risky? Because you only risky 480, man. Multiplied by 100 means $480. You're only risking $480. So, like, what is the catch? Okay, I'll just review the answer. The answer is that the chances of you losing this, like the chances of the SPY shares going below 505 is actually quite high. That means the potential of you losing this whole $480 is quite high. But because we're only investing $480, right? We lose $480, it's not a big deal, right? It's not a big deal, right?
Mm-hmm.
I believe for the two of you are so rich, $480 USD is not a big deal. But if we put in $48,000 in, right? Because we started off with 50,000, right? If we put in $48,000 into this, that means maximum loss is $48,000, and the chances is quite high. I mean, quite high is in the sense that, like, even if it's 30% odds, it's still quite high, right? The chances of you losing $48,000 is not minuscule, because the chances is more like it will be somewhere in the middle, right? You will not mix maximum, you will not lose maximum. You somewhere in the middle, right? It's like you can think of it like a Gaussian curve. It's somewhere in the middle. But of course, this is another story. It actually doesn't move in a Gaussian. It's more a heavy tail, but it's more likely to be in the middle, right? So okay. So what I'm trying to say is that if you put $48,000 in, you have a rather good percentage odds of you losing everything. That means ideally nobody should put in too much money into this trade. You don't want to lose $48,000. If you think about it, if you put that $48,000 into SPY shares, what is the chance of you losing the whole $48,000?
Very low. Impossible.
Yeah, it's almost impossible, right? But of course, Armageddon, if it's the who's the guy in the movie Armageddon, right? If the meteorite came and then the whole earth go gone, then that will happen. Your $48,000 will be gone, but you will be gone as well, probably, right? But but for option trade, so the reason why we only put in a little bit of money as a leverage thing is because the chances of you losing everything is not zero. It's not even close to zero. It could be 10%, maybe 20%. Okay, so basically the way, this is a trick. This is more it's a good thing for you guys to know about this. Delta option has this delta thing, right? So delta can be a rough way for you to assess the probability, although it's not really entirely accurate. But for a quick calculation, it's good. So if the delta is 10, 0.10, right? If it's 0.10, that means you have a 10% chance of losing everything, right? Delta 0.10 is chances of losing everything is 10%. So for example, I didn't really compute this delta, but we can compute it. Basically, it's the delta of the long short, the delta of the short. Basically, in this case, probably is around 10%. So the chances of you losing everything is 10%. And of course, the chances of you making, if it's just a symmetrical, like a Gaussian, a normal distribution curve, the chances of you making this is also 10%. So you're more likely, like 80% of the chances is somewhere in the middle. So the whole idea is, okay, we don't want to lose everything. We just want to do this as a more like a leverage thing. It's not like, like you go to all those Hong Kong movie, right? The Dousan, I show hand, right? Or this is show hand. If you put everything is show hand in. But if you lose everything, right? Yeah.
Mm-hmm.
Of course, I'm not advising that.
That makes sense. We have 5 to 10 more minutes to go. I have two more questions. How do you determine what's the strike price to buy it at? I mean, how do you pick 525, 505, 540, 560, right?
Okay. Okay, that's a good question. So I think 506 is the price, right? Yeah, 507.
506 is the price we bought it, right? 507.
Yeah, okay. So we have 540, right? And we have what was the make sure it's 505 and 540, right?
Yes.
So 505 is this and 540 is this, right? So this is the short call strike price, 540, and 505 is the long call strike price. And the current price is about somewhere here, 507, right? This 509 is a break-even point. In this case, we just ignore it. We don't have time to cover in this podcast. But the current price is 507, is around here. Okay, so first thing that was in my my thinking was, okay, first I just set the direction of the market. So do I think the market is going to go up, or it's going to go down, or going to stay sideways? Okay, for JasonInvesting, we always we always assume that the market will go up. Right? We always bet the market will go up. Like, we will not short the market. As much as possible, we will not short the market. So if our model, if my statistical model tells me that, okay, most likely market is going to go down, I will just stay neutral, or I will reduce my long side to almost neutral. I will try not to go short, because the thing is that the market in the long run always goes up. So when I was saying, that you can leverage, you can also reduce the risk. So basically, it's possible to also reduce the risk, but you have to make the right call. So which is make the right decision as the market will go up or down, right? Which is actually like a coin toss as well. You will not get it right. Okay, Andre, you have a question?
For market, isn't it either go up or go down? How come it's there's a neutral?
No, I mean as in, no, the market can stay neutral. It can go sideways. It will neither go up or go down.
But when you're saying go up or go down, that is the price, right? So price, how can it be so exact?
No, of course it's not going to be exactly not moving. It will go up one day, go down the other day, go up one day, go up down the other day. On average, go up for a few days, then it will go down one day, drop everything. So in the end, the market is like moving sideways. Basically, when I say neutral, that means I am not betting that the market will go up or down. So basically, for example, dollar cost averaging, the SPY shares, we will never sell them. So we always have 90 or more shares, but I would sell more call option or buy put option in such a way that I will put the delta very close to zero, right? It means that is called market neutral. Okay, anyway, back to Kenneth's question. So first of all, I make the decision whether market will go up or go down, right? So in this case, because in February, the market actually went up. It only dropped recently for the past 2 weeks, right? So turned out our call was correct, right? That the market will go up. So first of all, I long this call 505, which is slightly below the market price of 507, which means that this call option is actually in the money, which means that it's actually quite expensive. because you have to pay a lot of premium for it. That's why it's so expensive. You remember it was 11.18. If the call option, you choose one that's very far away, the cheaper it is. Like for example, the 540, we short, right? But we could have long this call option. If we long this call option, it will only cost us $45. But if by April the market closed above 540, I actually make money, right? By just risking $45, I can make a lot of money. But now I choose to long a rather expensive call option, which cost me 11.18, which is $1,100, right? $18, which is a lot more expensive than $45. So, but then what I'm thinking is that, okay, market is probably going to go up, and I want to leverage by leveraging the 90 shares, because every one contract is like 100 shares, right? The delta is probably about 0.5 or 0.55. That means basically it's like 55 shares. 50 shares. If the delta is 50, it's like 50 shares, right? Out of 100 shares. So it will move like a 50 shares. So basically, I just do this, and then at 540, I reckon, right? Actually, my model actually shows that 540 is 95% confidence interval on the high side. So the chances of it hitting 540 is pretty low. It's like a 0. Like a maybe 2.5% chance of hitting 540. So basically, I just sell this because I was thinking if the market keeps going up, this long 505 will make a lot of money, right? Will be going up. Then I want you to like, okay, if okay, like this 540, it cap here, right? But if I sell a call option lower, it will cap lower, right? If I sell the call option higher, I will cap higher, right? So basically, I wanted to put in such a way that 540 will probably expire worthless, and that means it will probably be somewhere here, and the market will close somewhere here. But of course, if it goes higher, it doesn't matter. It's good for me too, right? Because that will be my maximum gain. Yeah, but the idea is, this is roughly the market will by April it will be around here, and then I will make this payoff diagram, someone like this. Yeah.
Yes, for the 505 call option, right? Right now our what is it? The premium is what is it? The 11.1 right? Times by 100, right? And then like basically $1,000 for one contract, and you bought three of them, right? So it's like 3,300 in here, right?
But okay, but for the other two, we just ignore for now. We can cover the next
Okay,
podcast.
okay, got it.
Yeah.
Okay, so sure, no problem. Let's say assume we bought one, so my cost is $1,100, and what is the price that the market needs to hit in order for me to break even?
Okay, that's a good point. But then I need to correct you first. Our cost is not $1,100. It's actually $480.
Okay,
Because
okay,
because of this premium, right? The $7 premium. Hey, I think I actually made a mistake. This is not $7. This should be 70 cents, right? I think this is 70 cents. Yeah.
Okay.
No, 70. Yeah, 0.7. It's not $7. So basically, it's not 480 so low. It's actually somewhere above. It was just somewhere here. Yeah, actually, I got confused. This is actually 70. It's not $7. It's 0.7. So it's actually just a little bit. Yeah, just reducing. So you're only reducing a little bit of the short call. I mean, your long is so basically it's 1,100 minus $70.
Okay, okay, man. Yeah, okay.
So it's not strictly maximum loss, which is $1,100.
Okay.
So you say break even. Okay. So when I was doing this, when I was generating this graph, right, in R, I took the assumption that it was $7 for the premium. So if it's $7, okay, this is just a hypothetical, right? If it's $7, basically your break even point will be 509.8.
Okay, that's not that bad.
Yeah. The reason why it's 509.8 is because you need the market to go up a little bit, right? In order to cover your cost. Your cost in this case is 11.18 minus 7, right? So it needs to move up here to cover the cost. So this is the part that you cover the cost. So anything above 510 and above, basically you will start making money. Anything below this, you will lose money, but your maximum loss will be capped here.
Okay, cool. I have one last question is, how do you determine the date? Like you have April 24th, you have May 24th, and March 24th, right? How do I pick it?
So, okay, the way I did it was, okay, actually, this is a complicated question to answer because there are various reasons why we do this. Because option has time decay. So every day you will lose money. Just if you're long call option, every day you will lose money, right? Because the chances of you hitting the strike price will become lower each passing day, right?
Yes.
And then if you're short the option, every day you will make money because every day pass, if you don't hit the strike price, you get to keep the premium, right? So the reason why I spread it out in this manner is because I want to balance out the time decay losses, and also time decay also work differently depending on the expiration date. So time decay is the fastest in the nearer term, and is the slowest in the further term, right? So basically, I try to average it out so that my time decay, because I'm net long call option in this case. So every day passes, I actually lose money if the market doesn't go above the strike price. Yeah, but this time decay is relatively small in comparison with what we will make from if the market goes to the level that we want. Yeah, but different strategy will be different. So some people, they might do a net short strategy, and then their time decay will be very high, right? And because they are making money from the time decay, right? So that will be but in our strategy, we try to minimize the time decay. So that's only one reason why I did the trade the way I did it. But also there are other factors that are involved as well.
I see. That makes sense.
Yeah.
Okay. So basically, the reason why we spread it out is you want to spread out the time decay, right? And I guess this is the method
one of the reasons.
One of the reasons that we are using in JasonInvesting. .com, right? Yeah.
And another reason is also because say time decay is one thing, and you just imagine, okay, so say this is in March, right? So what happens after March, right? You need to initiate another trade, right? Because we want to do it in a continuous manner. So the way I do it, I stagger these thing is because once this expire, I will roll it to the next one. So it will be like after May, it will be June, right? July. So I will just continuously roll the position. So so this is one thing that is rather important for newcomers. They don't really understand this, right? They always think of a trade as a one independent trade, but it's actually not. You always have to continuously roll your position. Your losing position, you might want to roll it, or your winning position, you also will want to roll it. So yeah, it gets very complicated. Which is why I suggest for the listeners and viewers out there, if you're interested, please sign up for our basic options trading course. We will cover everything. But the idea of the newsletter is that you have a rough idea about all this strategy, but you don't really need to have this headache of what strike price choose and stuff like that. Because for the newsletter, we will, if you meet our risk profile, we will suggest these strike prices for you, so that you don't actually have to worry. But it's pertinent that you understand how the underlying works, because if not, because the disclaimer is that any losses is entirely entirely your problem, right? So you need to be cognizant of what exactly of how this thing. You cannot let other people make that decision for you. But we will do all this choice for you, and then you will have to understand, and then you accept the risk. Yeah, basically that's it. And every rolling, we will also give you the notifications as well.
that wow, that makes sense. I mean, I'm definitely excited to learn more about rolling over and then how you pick those prices and how you spread out the time decay. This session is definitely fully packed. I mean, okay, like unfortunately we are out of time. So I mean, thank you so much for joining Jason and Andre, and for the readers out there, remember to follow our channel and sign up on our newsletter. We're gonna do more videos like this. Definitely. We will see you next time. Thank you so much.
All right. Thank you, everyone. Bye.
Bye.